Good afternoon, everyone. My name is Anthony Cohen. I'm the head product specialist for CQG for Asia Pacific. So today, I'm going to take a slightly different approach. I'm going to go into a more technical aspect of the precious metals derivatives by first looking at the spreads that are available and the opportunity on the spread market between different exchanges or even intra-exchange. A little bit about the technical analysis that CQG offers and the backtesting of strategies and the automation of strategies. Just like my previous colleagues, this is going to be a disclaimer. That's quite important to emphasize that anything that's covered today is purely informational and there is no trading advice being given. So the spreads we're going to be looking at today are, some of the main instruments that are covered. So we've got gold, silver, platinum on various exchanges, and we can see that spreads are not only tradable products, but they're also technical indicators that give investors and traders some kind of gauge of what the market is actually doing. And we can see this specifically looking at the gold-silver ratio spread. So what we're seeing here is purely the gold over silver price, and we can see a chart here of the spread going back to 1991, so quite some history, and we can see that it's actually been reaching some interesting points over periods like the dot-com bubble, the recent financial crisis, and obviously at a peak during the COVID outbreak when we reached $125. But gold really is the reason why it's an interesting spread is because gold has been obviously a safe haven product. People are going into it at times of difficulties. But on the other side, silver is more of a product that's got an actual industrial use. And when one goes, obviously, the spread going up means that gold, while there's still precious metals and while there's still a high relationship, we can see that gold starts to shoot up when something goes wrong. And obviously, it's quite no need to say that something is quite uncertain at the moment. So we kind of need to watch this particular spread over the next few months. So before trading spreads of any kind, there's something, it's important to know what we're looking at and to know how the spread behaves, who's in there, who's trading it, are there arbitrageurs in that market? Is it purely people trading at market? Is there some kind of coverage of market makers? And it's also quite important to know, or it's also part of a strategy to know where the other price is coming from. So where's the reference market? So what we're seeing here is the COMEX gold at the top, the OSC, so the old token gold in the middle, and the Japanese yen futures at the bottom. And what we're representing through these charts is what CQG assumes to be through an algorithm to be order modifications, so which we can see here, where you've got prices going up and prices going down in those kind of shapes. So we've got the offers at the top and the bids at the bottom. And they form these sort of shapes that you can see here, which really tell us that there are people doing some kind of arbitrage between those markets. Why are we assuming this? We can actually see it a little bit more clearly here when we can see that there's a relationship between prices. So when one price moves, you can see that the other price is going to be affected. And there's also a sort of relationship that's pretty clear, which comes into the contract sizes. So COMEX Gold has a size of approximately about $200,000 per lot. And OSE Gold weighs about 64,000 USD when we convert it into US dollars. So basically, we need about 3.1 times the value of one to make it level between the two contracts. The Japanese yen futures is about 84,000 USD. So to have a common denominator, you basically have, if I look at the notes, 2 contracts of COMEX Gold, 6 lots of OSE Gold, and 5 lots of Japanese yen futures. And that's why we're going to be seeing some of these, if we go back over here, sorry. So you basically see some of these values, some of these orders of 6 lots of gold and 1 lot of COMEX Gold. So these are just order modifications that tell us that there is already some kind of relationship and some kind of trading going on between those two products. So we kind of already know a little bit what's going on between those two gold contracts. And what we can also do is say, maybe there's also a relationship between gold products on intra-market, so between two similar products on similar exchange, but just different contract months. So when we look at that, we can see there's actually very similar sizes on two products. So we know that something is also going on between the December contract and the February contract of 2024 for that intra market. So we know where most of the volume is coming from. And same thing for that's the October 2024. So it's also something to see that there's, it's interesting to know where the high volumes are coming from. When there's a lot of sort of big volume orders coming through, like we can see here, it's also sort of interesting to know that there's big players in the market providing liquidity. So if we chart this actual spread, the COMEX TOCOM spread, but also taking the Japanese yen futures into consideration, we can chart it using a more traditional chart. And what it actually shows is there's a stability of price. So price sort of evolves around a sort of mean with some spikes, obviously here, which corresponds to the COVID outbreak. But on a sort of long-term basis, you know that the price has a mean of a certain level, and that the opportunities will arise when there's irregular prices coming through like this. So on platinum, similar setup. We can see separate bids, which are 1 lots and 5 lots. And why is it important? Because we need to know that there is some kind of liquidity being provided. Because if you go into that market and try to trade the spread without any liquidity, it's going to be a problem. So there needs to be a little bit of liquidity before going into it. The silver spread is quite similar, but we can see that so there's still a sort of a mean aspect to it, but there's it's a little bit less pronounced, and there's a lot more spike that kind of provides some opportunities, but it's a little bit less traded than the gold spread that we saw earlier. So now we can move on to the technical analysis portion, and we're going to be looking at different aspects of it. So technical analysis is obviously something that's quite common, but it's not a simple combination of, it's not just finding one particular technical indicator and just applying it. It's like a combination of studies and tools that allow you to sort of gather the information to take the decision. And we're going to look at the long-term aspect of charting, the short-term analysis, and then some trend following and volume-based charts as well. So for the long-term tools, we can look at, so this is COMEX Gold on a quite sort of long-term basis and a different representation. Some of you are familiar with market profile. It's one of the greatest tools to analyze levels, which is what we're doing here. So you can look at it on a long-term basis. You can look at it on a shorter-term basis, on an intraday basis. And all it does really is that it represents the aggregated time periods that have traded over the years. So what we've done is we've basically compressed the data since 1974 for COMEX Gold. And you can see the sort of relationship between the traditional chart and this market profile chart that shows you that the sort of accumulation of times where people have transacted at prices show you where the prices have been accepted. People want to transact at those distributions, and people have not wanted to transact at those. So we're looking here at a sort of distribution basis of gold, where the main ones would be at $1,737, 1303, and the biggest concentration at 362. So these are just telling us that these are the areas where trading has been mostly gathered. For silver, same setup, but we see that the bulk of it is actually much lower, where there is the highest concentration and the biggest distribution is at $4.77, followed by $16.695 and $22.16, where it's kind of that distribution is kind of forming and is currently trading. Moving on to platinum, where we can not only see the sort of the long-term distributions, but also, so it's a lot more defined here, but what we're also looking at is where it's currently trading. So it's probably a couple of days old, so hopefully we've not had a 100% move. But we're basically taking this area and then looking at it on an intraday basis. So you can see the relationship between the days and how the distributions are formed throughout the days as well. So it's telling us that we're currently trading in that area and that it's probably going to spend some time in that zone. But if it actually moves on to higher prices, we might stay around here or actually go back and complete the distribution at the bottom. These troughs, the lower areas, are the ones where when we move from one distribution, it's likely that if it breaches it, it'll go quicker to the bottom distribution. And palladium is actually a little bit less defined, but it's also something that can help try and find or preempt the sort of distributions, because we can see here the distribution between 2970 and 1134. It's not really sort of completed, but it's something that's about to either get rejected where we're at now and go back to the 756 area, or just go back up and complete that distribution. And you can see that on the chart. It's a lot more, there's less to work on an actual traditional bar chart. So there's a lot more information that can be applied using a different type of chart and a different instrument. So we can also use this on a spread chart, and this is the spread that we had earlier. This is the gold-silver ratio spread that's applied onto market profile, just telling us that we're currently trading at the top of this kind of distribution. So we're looking at potentially being at the top of the standard deviation of that distribution. So it's an interesting point for that spread as well. So as I said, it's not just looking at it on a chart, on a traditional chart that we saw earlier, but it's also confirmed by market profile that something is brewing here. That blue area shows that this is looking at a sort of extreme aspect of that spread. We're trading in high deviation, 2 deviations away from the mean. So something else to watch here. Okay, so for the short term, it's going to look a lot different. We're looking into not a time-based chart type, but we have a T-flow chart, which is a non-timed bar. It's really something that shows the relationship between the bids and offers, the bidding and the offering at specific prices, and the sort of the strength between the buyers and the sellers. So if you look at a typical bar, the buying is obviously represented by the green and the selling by the red. So you can see the buyer pressure and the seller's pressure on the bars. We can also see at the bottom the a sort of algo finder, which shows you who's in the market as well, because it kind of represents iceberg orders that we believe are in the market. And that kind of gives an idea of the kind of activity that can occur at certain prices. So when we look at this particular area here, we can identify large buyers going into the market. All of the offers are being bought into, and this is what's represented by those particular bars. And also confirmed with an iceberg order that was detected at 2012.4. And we can see the sort of breakdown. If we highlight this, we'll see the breakdown of the iceberg on the chart. And there's also another area here. Sorry, I'm not pointing pretty well, but here we can see some aggressive selling, which is characterized by a succession of red bars in the sort of triangular shape, which is that when people are selling into the bid, we'll see, and the offer is not moving, you're going to see a triangular shape like this. So you can see the activity of these particular markets sort of shown in a completely different manner. We have the similar setup on silver. We've basically done a little bit of a change here because we're using an aggregated chart. So all we're doing is we're aggregating the volume of the buyers and the sellers over 5 bars, just to make it a little bit more compact. But it's showing a more, what we call a geometric chart, which is a lot easier to analyze. And if you aggregate more, you'll be able to get more history to analyze. But we're also seeing that there's less algo orders in that market. So that's quite interesting piece of information when you compare gold and silver. For the trend following, something that we want to highlight is obviously there are a lot of traditional tools. When you look at technical analysis, you've got MACDs, you've got RSIs, you've got the sort of the good old technical indicators. But there's also ways to apply some very simple processes and some very simple techniques and sort of use them a little bit differently. So that's just an example of what we can do with sort of trend following, where we're looking at what we call fractals, which are simply sort of reversal points. And we're looking at successive higher fractals and successive lower fractals, just to try and define a trend. So the trend is obviously a succession of higher highs and higher lows for an uptrend, and lower highs, lower lows for a downtrend. So if we just take that simple process and just chart it a little bit differently, what it does is it gives us a reference historically of what the price is doing, and is a trend about to end, or is that a sort of beginning of it? And if we see here that we're reaching a certain number of successive higher highs and higher lows, or lower highs and lower lows for the other side, then we get an idea, and we can see that this sort of confirms here that when we reach a certain level, the market's going to start to turn around. And it was reconfirmed here, can't point properly, but we can reconfirm on the second accumulation there that this is confirming the end of the trend. For the volume-based indicators, we can take different things, different indicators, which are both based on price and based on volume. So what we've got here is we're basically overlaying a regular chart of, this is palladium. So we've got our regular chart, and we're overlaying the distribution of actual volume. So compared to what we saw earlier with market profile, this is volume profile. So this is actual traded volume. And we also have a certain type of pivot points, which is called range deviation pivots, which give us indications throughout the day what we can expect in terms of support and resistance. And we can confirm with volume profile and the actual chart whether these levels are respected or not. And we can see that this is the case over here, where you'll see an accumulation of volume at one of the deviation pivots over here, similar here, and for a few more days. So what we're trying to do is we're merging all sorts of aspects of it based on price, based on volume, and based on projection. Now, backtesting. So this is really taking an example, a simple example, just to make it accessible, of a candlestick formation. This is pretty sort of well known. And what we're doing here is we're taking a set of signals, any kind of signals. Again, this is just an example. There's no advice behind this, but we're trying to take a set of signals and backtest that, because it's an extremely important process for traders and investors to try and understand whether using certain of these signals actually work throughout history, and try and ensure that before getting into this market, you know about the risks behind it, the expected drawdowns, and see if you can come up with a strategy that allows you to continue making money even though the market structure might change over time. So you can test some of these strategies and evaluate risk and evaluate profits before you decide to actually trade it. So what we're doing is simply looking at the candlestick formation, which is something that's quite well known, even especially over here, where you've got some preset formations based on 1-bar formation, 2-bar formations, and 3-bar formations. So we've got some dojis, we've got some shooting stars, etc. And we're going to say, are these going to work? If we establish a very simple stop loss and profit taking, kind of randomized. And when we move on to here, we created a strategy and we'll run them through an optimizer that will say, try and find which one works the best over a certain amount of bars. So it's really trying to find whether there's actually truth behind it, how much risk is there behind this each of these strategies, how many trades it'll execute, or how many trades it has executed, and then all the statistics that come with it, which would be obviously the number of trades, the maximum drawdowns, the average profits, the profit-loss ratio, and so on. So when we've run through this, we get an idea of what's actually going on. So these are the important points. The number of trades, it's a key statistic, because if you run a system with 10 trades, it's not really meaningful. You have to have a lot of trades to be able to say that the statistic actually means something. If you have a 60% win rate on 100 trades compared to 60% of 1,000 trades, you'll see that it's a lot more difficult to achieve. Average profit, again, a simple thing, but often very much ignored, because it represents the profits divided by the number of trades. And a lot of the times, traders find something that they believe is is working. But if you trade 1,000 times and you only make one tick worth of money for every trade, you can be pretty sure that when you run this in the real market, it'll lose money because of slippage, because you can't really get executed at the price that you expected all the time. Profit loss ratio, that's a simple total profits divided by total losses. And historically, it's been proved to be one of the statistics that you know will characterize your system pretty well. If you have something that's below 2, the system is likely to be working for some time and then stop after a while. So it's a key statistic as well. It's one that we look at very, very much. And then the last one is the remove to neutral. So again, it's something that's it's actually one of the most important, which says if you have 1,000 trades and if you take out 10 of the most profitable trades from those 1,000 trades and your system goes from positive to 0, it means you've only picked a system that has a few occasional big winners, whereas you want something that's a lot more stable. So it's a very important stat to look at. And then the automation, it comes in different forms. I won't go through everything, so I'm going to focus on the indicator-based automation to conclude the presentation. And what it does is it simply takes our strategy that we just backtested earlier, and it will allow you to quickly turn it on and then start placing orders based on the signals that you defined. And as you can see, it's pretty straightforward. So all it's requiring is for the strategy to be backtested, and then on it goes. So that concludes the presentation. If you have any questions, I'll be happy to answer that later. Thank you.